Double entry bookkeeping. Introduction. In this module, you will learn about double entry bookkeeping, a fundamental concept of accounting that states that every financial transaction has equal and opposite effects in at least two different accounts. Topics to be covered. Introduction of double entry bookkeeping. What does the account show? Account name. Debits and credits. Account details. Rules for double entry transactions. Accounting for inventory. Double entry transactions for inventory. Returns of inventory. Drawings. Income and expenses. How many different expense accounts should be opened? Balancing accounts. General rules for balancing accounts. Introduction of double entry bookkeeping. Accounts are used to monitor business transactions. Double entry bookkeeping is the process of maintaining and recording transactions in these accounts. The word double entry is used because each transaction has two distinct effects on the company. Purchasing a new machine for cash, for example, will affect both the equipment and cash assets. Similarly, selling inventory on credit affects both the inventory asset and the trade payables liability. A double entry account would generally appear as follows. What does the account show? Account name. The account's name denotes the form of transaction. If the account is used to purchase or sell equipment, for example, the account could simply be called machinery. This implies that each form of transaction will be registered in its own account. Debits and credits. The left and right sides of the account are referred to as the debit side, doctor, and credit side, sir. These terminologies may be used to describe the process of creating entries. When you say you're debiting an account, you're simply referring to making an entry on the account's debit side, the left-hand side. Account details. The name of the other account, which the transaction also affects, will be included in the information element of each side of the account. Each transaction will affect two accounts as a result of symmetry, hence the word double entry, and the information of each account will apply to the other account that will be affected. Some basic principles must be applied when recording double entry transactions. Every transaction requires two entries to be made in separate accounts. Every transaction requires one debit entry and one credit entry to be made in each of the two accounts. Rules for double entry transactions. It is vital that transactions are recorded correctly. For this, you need to establish on which side of the account each transaction needs to be recorded. For example, should you debit or credit an account? This will depend on the type of account that you are dealing with. To start with, you will have to consider three separate types of account: assets, liabilities, capital.